So we're going to talk about everyone's favorite topic in retirement planning, and that is putting your expenses under the microscope. This is something we harp on a lot when we're talking to folks about retirement planning. Expenses are the biggest driver of what your retirement plan is going to look like. If you want to spend a lot of money, you got to have a lot of money, and you're going to need to take a lot of money from your portfolio. So your your starting point better be pretty high. This all was prompted by an article in the Wall Street Journal. Retired couple kind of is tracking their retirement, and their latest endeavor was, putting their expenses under the microscope. I think that they found they had some unused recurring subscriptions, which amounted to, maybe a couple $100s per month. So it's good. It's good to do that. Good practice to keep things clean. Make sure nothing is getting swept under the rug or not noticed. But I think the big takeaway for me after reading it was the big items in retirement, meaning your housing costs, maybe you got some outstanding car loans or other outstanding debt. Those big ticket items are really gonna move the needle in one direction or the other, if you will, in retirement.
Ongoing debate in finance Twitter, I think since Twitter began, was if you have a low interest rate on your mortgage, should you pay off your mortgage or just keep it going? There's folks out there that say you'll never get 3 or 4% on a mortgage ever again. And so it's a low cost loan and it's cheap money. And I certainly get it. I usually talk about the peace of mind that comes when you don't have to pay a $2,600 mortgage payment or whatever it is that you're paying every month. Certainly in retirement, it doesn't matter what the rate is. It's a big nut to cover every month.
It is, but I think especially with the mortgage decision, you also need to look at let's say you have $100,000 left on your mortgage. What does pulling $100,000 from your overall portfolio do to the total that you have to work with? You're pulling $100K out of a balance that you would have to make last for the next 30 years. So
suppose you had $100,000 left on a mortgage and you had, let's just use the number that I was using, $2,600 mortgage payment. That's 38 months. So about 3 years. So I don't know. I think the answer is going to be different for everybody, whether to say, hey, I'm going to take, 3 years of mortgage payments and prepay it and be done with this thing. And then I'm not going to have that monthly payment anymore. Yeah, you're still going to have insurance. You're still going to have property taxes. They never go down. But yeah, is it worth it? This is why you talk to a planner, to do this kind of math and these projections. Let's see what your numbers look like keeping the mortgage versus let's just get rid of it.
Exactly. Yeah, that's the type of analysis that we often end up doing. I think going back to the article, I think the upkeep, this couple lives in an older home where the upkeep is pretty extensive. Things are, falling apart, and there's big projects that have to be done on the house. So just because, you don't have a mortgage, like you said, Tom, you're going to have property taxes at the very least. You're going to have big bills. Upkeep is going to be an ongoing thing. And their point was, what if we sell the house and then move or rent even a condo? They were talking about moving across the country, but, especially here in New Jersey, I think, if you've been in your home for a while, you've probably seen a good amount of appreciation in the home's value. You could probably make a good amount, and then, maybe you rent something, you stay in the area, and you don't have to do that upkeep, especially as you get older and you age more and you're not able to move around the house as well as you were when you were, younger. Doing that upkeep, that's, another question is like, are you physically able to continue to do that on top of the expenses that come along with that? These are all things that we're talking about. Yeah, I think it's a trade-off there in terms of like what makes financial sense for you and what you'd be happy with. I feel like for some people, getting the money from selling your house and then having, more in your portfolio while you rent something works for them. Other people like owning their house and having a place that they, that's theirs. No one's going to up the rent or force them out or change anything about the agreement year to year, things like that. So yeah, there's a lot of considerations. Selling your house and renting is not going to work for a lot of people. But there's definitely different levers that you could pull if you want to improve your situation or just change things up once you get to retirement. I think just like you were saying, the big ticket items are really what's going to improve a situation, and something that we come across for a lot of people when they're considering whether to retire or not. Depending on what age they are, it's, how are you going to cover healthcare? Once you retire, usually healthcare is tied. You get benefits through your job. If you're not 65 and you're not Medicare age, you're going to have to be on the open market for healthcare costs. And that's usually one of the biggest hurdles for people if they want to retire at age 58, 59, 60 years old.
Yeah.
I feel like people underestimate or don't even think about it at all, how much getting open market coverage is going to cost them and how much it's going to, take away from their ability to retire at all.
Yeah. What Tim is bringing up here has killed a lot of early retirement plans for folks that we've talked to, in the sense that, gosh, they didn't figure out that fill in the blank $2,000. They're going to need $2,000 a month to go just towards healthcare premiums. And that may come with a high deductible, $5,000 or more. So yeah, it really does change the landscape.
Or if you could opt for a plan that doesn't cost a lot, but you could potentially be leaving yourself open to, a very large medical bill if things go wrong. Like the different types of coverage, you could take the most expensive plan out there and be covered for every single possible thing under the sun. Or you could go the opposite route and try and minimize your costs on a monthly basis. But then, God forbid, something bad happens to you, you're going to be on the hook for a pretty hefty bill.
I'll also add, in a positive way, that if you decide to retire and you stop working, we've run into a lot of folks that think automatically, well, every 2 weeks or twice a month or whatever, when I get paid, I bring this to my checking account, to my bank account. This is what I get. And my expenses are X and my income is Y, and this is how I figure things out. But a lot of people overlook the fact that once they stop working, they're not going to be contributing to a 401k. Those expenses that came out pre-tax, they fall away. You're not going to have FICA coming out of your paycheck anymore. So your expenses are really going to change. And that's part of our job, is to help you realize, hey, some things fall away, other things do come up, and you need to be cognizant of this. Does it mean that we need to have, NFL red zone? I don't know. Maybe these are expenses we can cut.
Yes. No, that is necessary. Yeah, I think to that point and the healthcare point, I think, unfortunately, as people age, people's health tends to, get worse over time, and unexpected things happen. And I think that health care expenses, even if you have a good plan later in life, you might need to, go into an assisted living facility or have some in-home care or something like that. And those are really big ticket item things that come down later in life. So, but to the point, I think it's personal in terms of, is it better to have, more in your starting base, or more in your portfolio when you start and higher expenses, or is it better to have a lower starting point and lower expenses? It really is a personal decision that you have to make. We can share the dollars and cents with you. But one thing I do want to point out is the expenses. Why we hammer it home so much is because it is one of the, most malleable factors in the retirement plan. You have direct control to a certain extent, of course, but you have direct control over what your expenses are, meaning that you can change them, you can tweak them as necessary. For retirees, one thing to consider is that, that starting base, that starting portfolio value, the market's going to give you something. We don't know what it's going to give you on a year-to-year basis, but over the long term, we expect that that's going to increase your portfolio value. But that starting base is your starting base. You probably don't want to go back to work if you've made that leap already. So you're not going to be making more income, but you can change your expenses. So I think that has to be taken into account when when someone's deciding this.
So you guys know that I listen to Founders podcast. I listen to every single episode, and the whole concept behind Founders podcast is these are business owners who have become very successful, and we just study what these people have done through their stories, their biographies of them. And in almost every single situation, these successful businesses were successful because they controlled their cost. They controlled their spending. It was Rockefeller who said, hey, look, I can't predict what kind of income or how the business is going to do from year to year. We're going to have periods of time where we do very poorly. But the one thing I can control is our expenses. And that is one thing you can control as someone who's contemplating retirement. Is I can't tell you what the stock market's going to give us next year or over the next 5 years or over the next 10 years. But I can do something about my expenses. I can control my expenses. And you got to focus on what you can control, because everything else, you're just spitting in the wind otherwise.
Yeah. Yeah, that's a tough question that you asked before. Like, would you rather have lower expenses and a lower amount or higher expenses and a higher base? I think I would opt for the lower expenses and the lower amount. But, we've seen people here that have, triple the amount of somebody else, but they're in a worse spot because they spend double the amount of what that person does. And things like medical costs popping up later in life, that could happen to somebody with low expenses or high expenses. Yeah. So I think keeping your expenses low, like you were saying, is that's the ticket for me, honestly. If you can figure out a way to spend less money, I think you're going to be better off. Yeah, best case scenario is you have a high asset starting total and low expenses. Yeah. So if you can do that, kudos to you. I think one thing we don't want to see when we're planning for retirement is, someone gets a little out over their skis in terms of expenses and they want to take more risk in their portfolio to try and out-earn their spending habits. I think that is a big no-no for us, especially if you're already drawing from the account.
It's a recipe for disaster.
Yeah. So just wanted to see that in there because I know that is a pretty common question that we come across all the time. So yeah, like a lot of things in retirement planning and personal finance, the answer is it depends on your personal situation and what you prefer and the trade-offs that you want to make.
Okay. That's going to wrap it up.
Cool. Did you hit the record button?
I used that joke last time. I don't think I will use it this time. So, but I left it in the last video also.
Yeah.
All right.
Cool.
Thanks, guys.